Right, what is up, you guys, and welcome to Business Foundations in a Changing World, episode 4. In this episode, we're going to be going over chapter 4, options for organizing business. We're also going to be talking about the different businesses, things like corporations, partnerships, S corporations, sole proprietorships, all of these. We're going to be talking about all of them and explain the differences, advantages, and disadvantages as well. Okay, so let's start with sole proprietorships. These are businesses that are owned and operated by one individual. So think of someone that, hey, I want to start a business, and he does start a business, or she starts a business, and that is called a sole proprietorship. Okay, so it's a business that is owned and operated by one individual. This is also the most common form of business organization in the United States. Okay, now these businesses usually or tend to focus a lot more on services rather than manufacturing, simply because having a whole manufacturing business behind your back as one individual is harder than having a service. Okay. Also, sole proprietorships tend to have fewer employees, so lesser than or fewer than 50 people. Okay. Compromise nearly three-quarters of all U.S. companies. Women business owners less likely to get access to credit. Okay, so if a woman wants to start her own and operate her own business, she's less likely to get access to credit. And we talked about credit in a previous episode about how banks trust you based on your credit score. Okay. Now let's take a look at some of the advantages of sole proprietorships. Okay, so these are advantages. Think of sole proprietorships as someone owning a business on his own. Okay, hence the name sole. Okay, so sole proprietorships. Again, advantages: ease and cost of formation, allows a high level of secrecy. You don't have to give out your financial statements to any of the government and investors on your part. Okay, obviously a big one as well. Owner gets to keep all profits that come from the business after taxation and salaries and such. You don't have to split them with someone else, for example. You are the owner, so you get to keep all the profits. Flexibility and control of the business itself. Well, I mean, if you're the owner of the business, it makes sense that everyone is going to follow what you say, even if they don't exactly like it. You may get some advice, but at the end of the day, your word is the one that's going to move the business along. Okay, government regulation is minimal. Again, your business is not exactly the biggest, so government regulation is going to be minimal. Taxes are going to be paid only once, and if something does go wrong with your business, it can be liquidated or dissolved easily. Okay, now let's take a look at some of the disadvantages of sole proprietorships. Now, disadvantages: you have unlimited liability, and what unlimited liability means is any debts that can happen to the business is on you. So you're the one that has to pay for any debt that the business goes into. Okay. As far as external funding, okay, so outside of your own money as the owner, there's really no one else that can give you extra money. When comparing it to corporations, corporations can put their stocks and let people buy shares from the stock market. That way they get extra money, but for you, you can't really do that. So you don't really have any external funding besides you and you only. Okay? Owners need diverse skills. Like we said, you as an owner, you need to have a lot of different diverse skills, and it can be quite the challenge to have or to employ people or find people with different diverse skills because of competition with corporations. And we'll talk about that in a second here. Success is again tied to the owner. So if you as an owner, you don't have a plan, you don't have managing skills, you're really not going to go far with your business. Hence the point above it: owners need diverse skills. Lack of qualified employees. Again, it's quite the challenge to find and hire qualified employees because of competition with corporations. And you get higher taxation rate because you are a sole proprietorship. Okay. Now let's go to, like we said, finding talented employees. This can be quite the challenge for sole proprietorships, simply because larger corporations offer better wages or hourly wages, and there's generally a lot more job opportunities in large corporations compared to sole proprietorships. Okay, so like we say, like you guys see here, difficult to match the wages and benefits offered by large corporations. Who wants to work for a small business if he can work or if he or she can work in a corporation with a much better wage, if you will, and benefits as well. Okay. Obviously, one thing that also comes into people's minds when hiring or when applying for a job is they want to develop, right? So if you're gonna go to a small business and you know you're not gonna go far, then why work there if I can work, and I'll give you the easiest example. Like I'll start at McDonald's at the very bottom, and over time, if I plan to stay there, I know that I'll get promoted again and again and again in like a couple years each time. Okay, so there's little chance for advancement within sole proprietorship. Okay, let's take a look at partnerships now. Okay, no, we moved on from sole proprietorships. Now let's move on to partnerships. So partnerships is a form of business organization defined by the Uniform Partnership Act as an association of two or more persons who carry on as co-owners of a business for profit. Okay, so I know this sounds a lot. What this basically means is a business that is started by a partnership, right? Two or more people as an association, right? And they both get to call themselves co-owners of the business, and they both make the same profit unless otherwise stated by both of them. Okay? So one way to minimize the disadvantages of sole proprietorship, like we saw before, and maximize its advantages is to have more than one owner. Like we said, having one owner is not exactly the best thing for a business. Now, adding two or five, for example, or three is a lot better than having one. Okay? Typically larger than sole proprietorships, but smaller than corporations. So a partnership is typically quite larger than sole proprietorships because there's more than one owner, but it is definitely much smaller than a corporation. Okay, so we have different types of partnerships. We're going to go over them here. So we have the general partnership, which basically involves a complete sharing in both the management and the liability of the business. So if the business was to go into, a lot of debt, for example, both partners would have to pay them out of pocket, okay? And management as well. So you can't go behind your partner's back and make crazy changes without your partner knowing. Now, moving on to the second and the opposite of general partnership, we have limited partnership. And this has at least one general partner who assumes unlimited liability and at least one limited partner whose liability is limited to his or her investment in the business. What this means is you have one general partner that has unlimited liability, so he gets, I'd say about 80 to 90% of the credit that can come with the business, and he or she usually has a lot to say, a lot more say in what happens or how the business moves. And then you have the other partner that is limited because of the amount of money that he invested into the business itself. So think of it as one business partner is higher than the other. Okay? So think of articles of partnership as, these are legal documents that prove that, hey, this is the basic agreement between us on paper. Okay? Now let's move on. Here we have advantages of partnerships. So advantages, again, much easier to organize than having it on your own. Availability of capital and credit. You can raise a lot more capital if you're in a partnership, and credit is much easier. Combined knowledge and skills. Again, a lot of people don't underestimate this part, is that two people can have different knowledge and skills and thus, make the business go forward a lot better. Swift decision making. Yeah. I mean, if you as a business owner have your own day job as well, decision making can quite take a hit if you're not, sharp on your time management. So having two or more people makes decision making a lot easier. And again, government regulations are still few. All right, let's take a look at disadvantages of partnerships. Disadvantages include unlimited liability. Again, all credit falls on you. Responsible for each other's decisions. Now, a lot of people, again, underestimate this. When you make a decision and things go wrong, if you do not have a good partner, he'll usually blame it on you, and you guys can get in fights. And like we know, not having trust is bad for business. Excuse me. A new agreement is needed if the partnership changes. Again, as the business grows, people tend to change, money starts coming in. Everybody wants to change stuff around the business, so new agreements have to be made on paper if the partnership does change. Difficult to sell a partnership interest. Pretty self-explanatory. Distribution of profits may be uneven. Now, Obviously, this again will depend on the business and the people running it itself, but again, profits can be spread unevenly. Cannot find external funding as easily as large corporations. Like we said, external funding is possible with partnerships, but it is, again, not as easy as large corporations have it. Okay, let's take a look at some of the keys to success in business partnerships. Okay, so keep profit sharing equitable based on contributions. Again, keep profit sharing between the two or more partners. Basically balance it out. Okay, like we said, we have different based on which kind of partnership you're having. Share the profits equally, if you will. Okay, partners should have different skill sets or resource contributions. Again, different partners or the two or more different partners should have different skill sets or resource contributions. Anything that can help the business in different ways. Ethics and compliance are required, like we said in the previous episode. Ethics and compliance is very important to a business. Must maintain effective communication skills. I mean, if you don't have the necessary communication skills to talk to your business and advertise your business, you're not going to go far. Maintain transparency with stakeholders. So we talked about stakeholders before, so you must maintain complete transparency when talking with stakeholders. Don't say, hey, I'm just going to keep this from them for a while until we sort things out, and then I'll let them know. You got to be as transparent and as honest as you possibly can. Must be realistic in research and financial management. Again, you don't want to go too high and say, hey, look, we're going to do this. We're going to go through all our resources, so I'll buy more now, just keep it, and then you end up not using it. And same thing with financial management. You think, hey, we're going to make a ton of money, and in the end, you don't make it. So you have to be realistic. Previous experience related to business is helpful. Now, this is not needed, in my opinion, but it's best to do your own research on the kind of business that you want to start. Again, research for anything in life is quite important. Maintain life balance in time spent on business. Pretty self-explanatory here. Focus on customer satisfaction and product quality. Again, these two are so important, and a lot of people don't think that they do. They think that, hey, the customer's just going to come in once and go. Customer satisfaction and word of mouth in general is super important when it comes to your business, especially if it's like a smaller business side. Like, look at, big corporations like Amazon and Apple. You see how they treat their customers, right? You have constant 24/7 support. And basically, if your customer is happy, he's going to talk, word of mouth is going to spread, and your business grows this way. And again, one more thing is product quality. If your product quality is bad, hey, no one wants to buy a bad product twice. So make sure product quality is on point. Maintain resources in line with sales and growth expectations and planning. Again, like we said, you don't want to buy or go through all your resources super quick so you end up getting more or not getting enough. You got to maintain everything according to plan and not go too high or too low. So basically being realistic and actually managing your business correctly. Okay, now let's move on to the big guys, aka corporations. So what is a corporation? That is a word that we hear a lot, but we don't know. A lot of people, you'd be surprised, don't know what it means. So simply put, a corporation is a legal entity created by the state whose assets and liabilities are separate from its owners, right? It has many of the rights, duties, and powers of a person. Things like owning and transferring property, entering contracts, and you can get sued or sue in court. These also account for the majority of all U.S. sales and income. Okay? Now, corporations are typically owned by many individuals and organizations who own shares of the business, and these are called stocks and dividends. So what is a stock? Stock is basically shares of the corporation that may be bought or sold. So think of a company as bricks, right? You as a person, you're like, hey, I want to buy like 2 bricks of said company. I'll use Coca-Cola, for example, right? I'll buy 2 bricks from a company that means 2 shares of the corporation. Now you own a small part of Coca-Cola, believe it or not, okay? These so-called bricks or shares or stocks can also be gifted or inherited later on in life. Okay? So you can buy them, you can sell them, and what people do is they usually buy stocks at a low price and sell at a high price. That is why it can be super difficult to predict the stock market, because you don't know when stocks are going to go up or when stocks are going to start going down. Okay? So that was stocks. Now let's talk about dividends. Dividends are profits of a corporation that are distributed in the form of cash payments to the stockholders, and I'll talk about that more in a second. So again, dividends, these are profits of a corporation that are distributed in the form of cash, so you end up getting cash payments to the stockholders. Okay, now let's talk about the different types of corporations. We have domestic corporation, and that is if conducting business in the state in which it was created or chartered. Okay, so a domestic corporation is, let's say, for example, the state started a corporation in San Francisco. If the corporation is still operating in San Francisco, then it is a domestic corporation. Second, we have foreign corporation, if conducting business outside the state in which it is created or chartered. So if the state created the same corporation in San Francisco, but they moved the corporation to, let's say, California, for example, right, or LA, then that means it is now called a foreign corporation. Then we have something called alien corporation, if conducting business outside the nation in which it is incorporated. So let's take that same example. Let's say that same corporation was started in San Francisco by the state, but the corporation moved to, let's say, Egypt, for example, right? That means that corporation is now completely alien. Okay, alien as in meaning outside of the country itself. Okay, let's take a look at private corporations and initial public offering or IPO. So private corporation, pretty self-explanatory, owned by just one or a few people who are closely involved in managing the business. Okay, none of their stock is sold to the public, so no stocks. You cannot buy stocks on a private corporation. Private companies are not required to disclose financial information publicly, and this is quite important. People do not understand that a lot of private companies do not like giving their financial information publicly and to the government, okay? Especially when they're not doing too well. Now let's take a look at IPO or initial public offering. Now, selling a corporation stock on the public markets for the first time, this is called an IPO, and it is usually done when a private corporation wishes to go public or to raise additional capital or expand. Let me give you an example. So let's say I own a private corporation, right? I do not sell my stocks or anything like that, but now I want to go public and raise capital so I can expand said corporation. That means I'll have to start selling stocks or shares of my company or my corporation on the stock market. Okay, let's move on. Now we have public corporations. Now public corporations is basically are corporations whose stock anyone may buy, sell, or trade. Okay, so now, these are corporations that you can go on the stock market right now and buy, sell, and trade, gift, inherit, all of the things that we talked about on stocks. Now, there are two different types of public corporations. You have quasi-public, which is a corporation that is owned and operated by the government. It usually provides a service, but often operates at a loss. But that's not really a big problem because it is the government that is operating and owning it. Then the second, we have nonprofit. This usually focuses on providing a service rather than making a profit, is not owned by the government, and they usually get money or capital from, like we said before in the previous episode, we have fundraising, a lot of people that can come in and contribute in any way, but they're not obligated to do so. Okay? Now let's take a look at board of directors. Okay, so what does that mean, board of directors? So board of directors is a group of individuals. No, they're a group of individuals elected by the stakeholders to oversee the general operation of the corporation, who set the corporation's long-range objectives. Okay, so to sum up what was just said here, okay, so these are a group of individuals. They are elected by the stockholders, so not people inside the company itself or the corporation itself, but rather stockholders, people that bought shares to oversee the general operation. So I'm a stockholder, right? I'll say, hey, I want this, these individuals to oversee the general operation of the corporation itself. Okay, what is happening from the inside? Okay, who set the corporation's long-term or long-range objectives. Again, these individuals, called the board of directors, are also the same ones that look at long-range objectives of the corporation. Again, this board of directors, they're responsible for meeting objectives on schedule, legally liable for mismanagement or misuse. Again, things can happen if they abuse their position of power. An important duty is to hire corporate officers. Inside directors are employees of the company itself, and outside directors are people simply unaffiliated with the company, but they swoop in to take a look every once in a while. Okay? Now let's take a look at preferred and common stocks. What is the difference between the two? Okay, so a preferred stock is a special type of stock whose owners, though not generally having a say in running the company, have a claim to profits before other stockholders do. Okay, so if you buy this preferred stock, okay, you don't generally have a say in running the company, so you cannot just go in, barge in and say, what are you guys doing, change this, change that. You don't do any of that. You simply make profits before any of the other stockholders do. Okay, so let me give you another example here, because I need to make sure everybody understands this. So I'll go to Coca-Cola, for example. I'll buy preferred stocks, right? I cannot tell them anything about how they run the company, and in return, they give me profits before any other stakeholders or stockholders. Okay? Let's move on to common stocks. So it's a stock whose owners have voting rights in the corporation, yet do not receive preferential treatment regarding dividends. So they may vote for proxy. That basically means allows stockholders to assign their voting privilege to someone else, and have preemptive rights, and that means they can buy any new shares of stock that the company issues. So this one's the common stock. This is the one that a lot of people go to. So you, as an owner of a common stock, you have voting rights in the corporation. You have a little bit of say in what does happen, but you don't exactly get preferential treatment, okay, when it comes to dividends. You can also vote to give such privilege to someone else and have preemptive rights. That means that if the company ends up, releasing extra shares and you have money, you can buy the extra shares right away. Okay, now let's take a look at preferred stock again. Again, like we said, owners of preferred stock have first claim to profit. Simple. Dividend payments on preferred stocks are usually a fixed percentage of the initial issuing price, and that is usually set by the board of directors. Okay, so this is quite important here. So when you buy preferred stock right here, you're usually buying, there's a fixed percentage that you get each year, okay, of the initial issuing price. So for example, let's say I'm going to go to Coca-Cola right now, and I want to buy preferred stock, okay? It costs $100 to get said stock, one preferred stock, okay? So the board of directors at Coca-Cola, they say, hey, your dividend rate is at 7.5%, okay? That means that every year I'm going to be paid by Coca-Cola 7.5% of that $100. That means $7.50 per year, okay? So again, the more shares you have, the more you're going to be paid based on this percentage. I hope that makes sense. You can pause the video and read this again and again, but it's really simple. It's quite simple, okay? So let's move on. We have advantages of corporations. Advantages to corporations, again, limited liability. When it comes to debt, you're not alone in this. Again, corporation, the big dogs, so limited liability. Ease of transfer of ownership. If something does go wrong, you can transfer ownership. Perpetual life, pretty self-explanatory. Securing funding is easier than for other forms of business. Again, you can secure funding a lot easier as a corporation than as a partnership, for example. And again, expansion potential is much higher than partnership and you owning a business by yourself. Okay, let's take a look at some of the disadvantages of corporation. Again, you don't get taxed once, you get double taxation. It's usually expensive to form corporations. It's quite hard. It's not easy. Or to grow your business to become a corporation. Disclosure of information to the government and the public. This has to be done if you're a corporation, might I add. So you have to give inside information to the government and the public. Owners and managers are not always the same and can have very different goals. And again, this can cause a bit of clash inside the business, if you will. And that's not good if you're a very big business, aka a corporation in this case. Okay? Let's take a look at joint venture and S corporation. So, what is a joint venture? It is a partnership established for a specific project or for a limited time. So, hey, we're going to do this partnership, but for one specific project or for a limited time from, 29/8 today to 29/8 in 2021. Okay? This is called a joint venture. Now, control in this case can be divided equally, or one partner may control decision making. They can, talk it out and see who wants more of, the decision making, the management, the financial section, or how they want to control the whole thing. Okay. This is basically used for ventures that call for large investments, such as development of new products. For example, let's say you're a corporation, right? And you want just a little bit of a section in the business itself that, hey, we're going to need a joint venture. That is basically the partnership that we set for a specific project. In this case, it is the development of new products, okay? From, let's say, this month to the next, to the next year, for example. I'm just giving, a very simple example here. Let's go over S corporation. Corporation taxed as though it were a partnership with restrictions on shareholders. Okay, so let me explain this. An S corporation is a type of corporation. Okay, it is called an S corporation, and it is basically a corporation that is taxed as though it were a partnership with restrictions on shareholders. So think of it as you're a corporation, but the government treats you as a partnership and not a corporation. But you get restrictions on shareholders, so you cannot just, throw your shares in the stock market and get unlimited money from people buying your shares. Okay? What this does, it eliminates double taxation. Like we said, this was a disadvantage here for corporations. So you end up removing double taxation, and this retains the limited liability benefit. So you get limited liability and you remove the double taxation part. Okay? Now, this helps you, and this is very popular among entrepreneurs, representing nearly half of all corporate filings. Okay, let's take a look at limited liability company and cooperatives, or co-ops. So, limited liability company, or LLC. Okay, so this is a form of ownership that gives you limited liability and taxation like a partnership, but what this does is it places fewer restrictions on the different members. Okay? Now, this is usually considered a blend of the best characteristics of corporations, partnerships, and sole proprietorships. So a limited liability company is something that gets the best characters of all three, which is corporations, sole proprietorships, and partnerships. Let's take a look at co-ops or cooperatives. These are organizations composed of individuals or small businesses that have banded together to reap the benefits of belonging to a larger organization. Okay, so think of you yourself having a small business and someone else having a small business and someone else on the other street having a small business. So what you guys say, hey, you know what? Let's all combine together to become a cooperative or a co-op, which is basically small businesses coming together to reap the benefits or to get the benefits of belonging to a larger organization. This is usually not set up to make money as an entity, but this is made so that members can, become more profitable or save money on not having to hire extra employees or not having to spend as much money on resources and such. Okay, so think of it as saving money and resources. This is what co-ops is usually good for. Okay, so this was episode 4, you guys. Let me know in the comments below if you have any questions or if you liked it or not, and I'll see you in the next one. Peace out.